Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information. Kate Campbell, welcome to this episode of the Australian Fine Arts Podcast. How are you going?
I am doing very well, Owen. It's wonderful to be back to discuss some questions that have come through from our podcast community today.
Yeah, it is. It's always good to do questions and get some answers, hopefully. You can send your questions in via the link in your podcast player. It says ask a question via any of the Rask websites or even the Rask community. We do get a lot of feedback on Spotify, Instagram, other places like that. People even send us DMs on our personal accounts. It's probably best to use the link in the podcast player. We probably take 95% of our questions that way because it just makes it easier. But these are the fun ones, Kate, where we get to hear from everyone and we get to share your ideas with the community. So, keen to get into it.
Yeah, it's also really interesting. The questions kind of give you a pulse check on what everyone is doing with their money and what is everyone thinking and how people are feeling about their finances, because you start to see trends come through with questions. So sometimes you see a lot of questions about bonds maybe, and sometimes you see a lot of questions coming through about interest rates and inflation, just depending on what's happening. So I find it quite entertaining and illuminating to go through that list of questions and see what people are asking. And we pick out some commonly asked questions at the time to share with you in our Q&As.
And we've got questions today on emergency funds. Someone's asking how much is too much. We've got questions about what happens to companies when they go bankrupt. What happens to how much you should add to bonds, or if you should even add to bond ETFs. Like, we talk about them occasionally on the show. And then just how do you make the most of everything that you've got in front of you? There's a few different questions here today. And of course, we'll have links in the show notes to things that we might reference. So you can check that out. Just a quick reminder that we do only offer general financial advice via these podcasts. Because we don't know your needs, goals, or objectives, you should seek a financial advisor who can give you one-on-one advice if that's what you need. And we even go one better. We have partnerships with our trusted financial planners and financial advisors, which you can find in every episode's show notes. So the same place that you find the link to ask a question in your podcast player, there's another one right near that says financial planning or financial advice. You can click on that and it takes you through an online form, and you automatically can book into the calendar of one of the financial advisors that we've selected. And they have a free discovery call with you. So you can jump on that call, you can talk to them, you can get a pulse check. If they're not right for you, you don't have to go ahead. But they can do the same, right? If they think that they can help you, they will offer their services. If they think they can't, well, they might push you back and say, hey, maybe go check out this Rask course, or hey, maybe you need to speak to a financial counselor, or hey, maybe you need a money coach rather than a financial advisor right now. And they can help connect you to the right people. So go and check that out, and be sure to read our financial services guide, or FSG, which is available on the Rask website.
All right, wonderful. Well, the very first question comes through from KC. Hi guys, I was just wondering how much is too much to have in savings if you're not saving for anything in particular? And if you have an emergency fund, do you keep 20 or 30 or 40,000? I'm assuming it's 40,000 in savings, or should you invest more? Thanks.
Yeah. Well, I thought KC here, because you picked this question, I thought it could stand for Kate Campbell. So don't know if the mighty Kate Campbell is getting advice or not. But no, it's a great question, because like some people, I think it's fair to say some people in the Rask community are over savers, Kate. They're over savers and they're under investors. At least if you go by some of the popular books that you might read. If you pick up the Barefoot Investor book, in the book he might say that 20% of your savings of your income should go to investing, like kind of like the future you. And then we have other rules that we come across, like the 50, 30, 20 budget, which many people would be familiar with. It's just dividing up, covering your life expenses, covering your wants and then your needs, and these types of things, and different ways and formulas of doing things. But I think you and I think I speak on behalf of both of us, Kate, that we've been doing this long enough to know that personal finances is quite personal. And so the way we treat where we allocate our money, it's okay to be a little bit different. Earlier on in my life, I can share that I was earning really good money. I was living in a share house, so I was able to save a lot of my income. Like at some stages, maybe 50% of my income I could save and either invest or put it towards something that I wanted. But obviously people, as they have kids, they have a mortgage, that kind of savings rate just simply isn't possible. And then you get later on in life, once the kids have flown the coop, they may be in a situation where you can really supercharge savings towards retirement. So I think in the context of that kind of life cycle that most of us go on, of course, not everyone has kids, not everyone has a mortgage, people come from different circumstances. Um, but I think if you take that into consideration, it's just about finding a happy medium for yourself. Now, if you put on a financial advice hat and you say, well, really, what's appropriate? It basically comes down to most people cannot save their way to an early retirement. And what I mean by that is most people can't just save money and then try and retire early or live a really comfortable lifestyle. It just doesn't happen. And if you wanted like some justification for that, just look at the superannuation system, which was brought in say the early 90s when it really began in earnest. The government forces you to invest. It's not forced savings, it's forced investing. And the government takes 10% of your wage and invests it for the long term in a tax effective way. So take it from the government that they want you to protect your future self. Now, if you want to wait until you can access super, that might be 65 for you. You probably need to invest yourself, at least something to get the ball rolling. And a lot of people are afraid to invest, Kate, because of things that they might have heard and what have you. And so I would say if this person's worried about, am I over saving? Like how much is too much? I would say if you're not investing, just try investing 1% of your income. I know that sounds like really funny, like if they've got so much in savings, maybe let's just stop for a second and just say 1%. Go and open a Pearl or Micro account, full disclosure, sponsor of the show, or a Raise account or a Sharesies account. Put $10 in a week and just see what happens. And I think naturally you'll come to this point where it's okay and you'll start to invest more and you'll begin to realize the power of compounding. That might take a few years for some people, but that's probably my general gist of this one, Kate. How about you? How do you think about saving? Because I know that this changed for you after COVID.
I bucket my cash. So when we're talking about savings, we're really referring to cash in a transaction account, a savings account, maybe even a term deposit. So I would bucket my cash into sort of 3 different piles, which would be my emergency fund. And I'm clear and I know what that is and I know the amount. And if I need to use it, then I'll work on topping it back up to that amount. And so that has grown over the years. So now that I have a mortgage, I want a little bit more so I know that I can cover multiple months of mortgage repayments if anything happens. And because I'm sort of working out what I'm doing, I want a little bit more flexibility. So having more cash aside helps me. So being super clear, and you can get to a number of what you want that emergency fund to look like. It might require a bit of thinking, tinkering, looking at your budget, sort of thinking how easy it would be for you to get another job, how many people you're supporting. But you can kind of work out that number and write it down and be like, okay, this is how much I have in my emergency fund. The second bucket I would look at with my savings is what goals am I saving towards? And sometimes the goal doesn't have quite a specific end number. It might be a bit open. So you might be saving for a house deposit over multiple years and the number might grow over that time. But you know those specific goals, the holiday, the new computer, the vacuum broke, the house deposit, that kind of thing. And then there's also that third bucket of cash, which is it's not really for a savings goal. It's not part of my emergency fund, but I haven't really figured out what to do with it yet. Maybe I'm just sort of putting a bit of cash aside. I haven't decided what to invest in. I'm not really sure what my goal is with that money. And that would probably be the most interesting bit for me because that's money that isn't going towards a short-term savings goal. It's not going towards my defined emergency fund, but I haven't quite figured out what to do with it. And I think that's where you might go, okay, well, am I going to keep adding money to that undefined pot of money that's not my short-term goals and it's not my emergency fund? Or am I going to start to think, well, maybe I could use a little bit of that to start investing and to get my feet into it and start to experiment with a micro investing app or experiment with one ETF?
That's really interesting, the 3 buckets or 3 piles. There's a really popular financial planning strategy for retirees. And this is for people approaching retirement, but also for people in retirement. And it's a 3-bucket strategy. And effectively, it's very similar to what you have, but just for all amounts of money. It's like 3 piles or 3 buckets. There's like the long term, which is just basically investing. And then there's this kind of middle bucket, which is that's kind of like the 2 to 5 year kind of bucket. And then there's like the next 2 years bucket, and that's like the immediate one. And basically what happens in this 3-bucket strategy, Kate, is the long-term investing feeds the middle bucket, which is kind of like, I'm going to go on a European holiday in the next 3 years. I need to slowly take some money out of my long-term bucket and pour it into that middle bucket. And then that bucket effectively can top up the first bucket if you need to. And it's kind of like the different 3 ways of putting it together. And most financial plans have that. Which is why we've always said, basically since Rask started in 2016, 2017, is that for retirees in particular, you're probably looking at about 2 years of living expenses in cash. And the reason that you have that for older folks is that period of your life is probably the most risky in terms of the transition. You go from having income to most of the time not having income, or at least quickly like reducing your current income. And so you rely on your nest egg. And if you can keep and maintain that 2-year buffer, effectively it means that you're not a panicked seller and you're not worried about how am I going to, buy the grandkids some Christmas presents this year or something. So that's for the older folks. For the younger folks, as a general rule, most people would be familiar with this concept of having like 6 months in living expenses. Now, you can probably bring that down a bit. You could probably say, well, I probably don't need 6 months. Maybe I need like at least 3 months or something like this. But what I would say in that situation is if you're trying to go to 3 months of living expenses, basically the less you have, the more stressed you'll feel financially. And if you're not at 3 months, that's okay. There are things you can do. We cover this in our debt demolition course and all of the free courses on the Rask website. But one of the things that you should be mindful of, if you do go to 3 months and that's what your living expense calculation you've worked out, that's my costs, is that you should definitely consider having really good insurance policies. And what I mean by that is I recently sat down with Phil Thompson from Sky, one of our advice partners, and we were talking about the different options for income protection. This is the insurance that pays out if you injure yourself and you can't work. A lot of people just rely on whatever's inside their super, which is oftentimes not enough. And sometimes with that insurance in particular, Kate, is that won't kick in for 3 or 6 months, or there can be different rules around that. And so if you don't have a full emergency fund in place yet, and you don't have your insurance like reviewed, you might end up in a situation where you frankly run out of money. So even if you don't have that savings buffer, what you can do is you can protect yourself in other ways. Maybe you can have a credit card that you're managing and you can consolidate. Maybe you can speak to a financial counselor. Maybe you can get that insurance in place. But once you have the insurance, once you have the savings buffer, it's then, how do I protect future me? And a really interesting thing is we all know that in the short term, stocks are pretty risky, like the stock market in general, even if you use ETFs. Same could be said for property, for what it's worth, or crypto, or any of those things. And we often say, don't invest money that you might need in the next 3 years. But Warren Buffett, I hate to bring him in during the first question, but he has this really important phrase, which I think we should remember, is that stocks are risky in the short term, but in the long term, they're risky not to own. And I paraphrase that, but basically it means that in the short term, you don't want to invest too much money because you might have a savings goal that you need to meet. But in the long term, you don't want to be in that situation where you're constantly on a treadmill. And the only way to do that is to invest so that your money grows. And that's that extra bucket or pile in your case, Kate, which is really important to consider. So find that balance in summary, and just make sure that you consider more than just the amount of money in your bank account.
Awesome. All right. The next question is, what happens to shareholders when companies fail? From Sexy Rexy. In the news recently, I saw that Rex Airlines went into voluntary administration. I like Rex mostly because they fly biggies. I'm not sure.
I'm not sure what that means.
Big planes. And let Hamish and Andy have a podcast party on their plane, but I've not invested. Question is, when a publicly listed company like Rex enters voluntary administration, what does this effectively mean for the investor? What does it mean for the company? I remember Virgin Airlines went into voluntary administration during COVID, but it still operates. Please educate me on this.
Yeah, so we as a team fly with Virgin. That's like our chosen airline for our business. And I was worried when Virgin was going bankrupt or like into administration. And I'll explain what that means in a moment. Because I thought, hold on a second, we've all accumulated all these like Virgin Velocity points. Are we not going to be able to claim these if they completely remove themselves? But basically what happens is you need to understand that a business, any business, the way it is funded is very much like your home, in that you have a mortgage on your home and you have the cash that you put in. You would know that if you go down this path, the banks want you to have a deposit of 20%, but some other people will call that equity. They'll say, you have 20% equity in your home, or I'm going to redraw the equity in my home. They will use phrases like this. And you'll see, if you use that phrase and you listen to enough finance stuff, that a lot of investors in the stock market don't call it the stock market. They don't even call it the share market. They call it the equity market. And so this is the idea that what you're actually buying in the share market is you're buying the equity part of a business. But obviously that business can have a bank loan. It can do all types of things to grow its business. So in the case of Virgin, and I haven't looked at Rex, but I imagine in the case of them, because it's the same with Qantas, a lot of the big airlines use debt like loans or financing, kind of like a car loan. They finance their airplanes. They don't actually own the airplanes themselves. They just finance them. And so what they do is they use that, right? But what happens in the event of, let's call it a voluntary administration or administration? What that basically means is the company is unable to continue operating under its current management. So what happens is the banks and the finance companies that have the mortgage effectively on those airplanes or on the business as a whole say, that's it, management team, you're out. We're going to appoint someone to come in and look at this and potentially look at if it's worth winding up or the best course of action. It would be like if you can't pay your mortgage on your house, the bank would take the keys eventually and they would say, listen, Kate, you're not paying the loan. We're going to sell this. And that's important to understand because in the meantime, the house still exists, right? The house is still there, right? Just because it's changed ownership doesn't mean that it just vanishes into thin air. And that's the same with companies. It's the same with Rex. It's the same with any company that goes out of business. Is effectively it's still in business. It's just changed ownership until they can figure out what they're going to do. And for shareholders, it's actually normally pretty bad news because it means that you're not going to get your money unless the banks and the finance companies that funded Rex get their money first. It's just like if you couldn't pay your mortgage, the bank gets the mortgage money first, and then you get whatever equity is left over. And it's really common. It happens around the world. But obviously, when you go and you buy individual shares, you want to make sure that the company doesn't have a lot of debt. It's got good cash flow. The business, you can understand it, and it's got a good runway. You can see the future for that business. Obviously, airlines, incredibly difficult businesses to run. There's a lot of debt in them.
Bookstores as well.
Well, yes, they're very similar in that they're probably industries that are hyper competitive and face disruption in certain regards. With books, obviously you've got Amazon, you've got Kindle, you've got all these different things that come in. The authors themselves will continue to thrive, but the book publishers themselves will struggle. And with airlines, you've got to remember it's not cheap to buy an airline. And it's interestingly, if you go through Sydney Airport, Melbourne, Perth, any international airport, what you should know is airports make a lot of their money by charging airplanes to land on their runways. And that is not a small fee. So every extra minute, every extra second that they're on the runway or at the gate, they're getting charged. And that's really important to understand because, yeah, sure, you as a consumer, you hate it when it sits on the runway for an extra 5 minutes and you're delayed. But so does the airline because the airline has to pay the airport. And if you've ever traveled to like the Melbourne to Sydney route, you'll know how often it's the busiest line in the world. You'll notice how often flights get cancelled. But what you'll also notice is that Qantas flights don't get cancelled as much as the other airlines. And that's because they basically have priority over the runway because they're more established, they're a bigger airline. And so the airlines actually compete for that runway share. And if there's a bit of wind, they get first priority over the new runway. And these are all things that happen. And so airlines like Rex, they come in, they try and compete against Qantas or Virgin or Etihad or any of the international airlines. It's not easy. And they're really hard businesses to run. So you could have figured all of that out just by doing extra research, looking at the profit margins, knowing who the competitors are, and so on and so forth. But that's the general gist. I think we've kind of covered that, Kay, but if I've missed anything, let me know.
Yeah, I think this might be an interesting case study to discuss on a future podcast because I've been watching the Booktopia drama play out and the new purchaser coming onto the scenes. And it could be interesting to discuss, well, what does that mean to shareholders, or what does that mean to customers? How does this process work of a new company taking over?
Yeah, well, that's our former senior analyst at Rask, Raymond Jang. He actually worked in this space, and he actually monitored the people that are brought in. His job was to make sure that they were doing the right job. When they were brought in and appointed to try and salvage these companies, his job was to monitor them. And that was really interesting just talking to him. But basically, if we go back to the house example as what might happen, many of us have heard of this idea of a mortgagee sale. This in the past was much more common because we didn't have the internet. You couldn't see what houses are coming available for sale. But there used to be things called like mortgagee sales. And basically what it was the bank had to sell because whoever was in the house couldn't afford to continue to meet the loan. And those houses would sell for much less than they normally would. And people who were shrewd buyers of those properties would go around trying to find where there's a mortgagee sale because, hey, like I can get it cheaper than normal because the bank needs to just get rid of it. So I'll go and buy it. And it's the same with things like Booktopia. It's the same with things like Rex. Like obviously there is some value in the Rex business. So some finance people will go in, look at it and be like, you know what? That airplane over there, that airplane is actually pretty good and it's probably worth more than what they think it's worth. I think I can sell that. So I'll buy that one and sell it. And then Rex as a company and its shareholders would take that money and then hopefully over time have enough money to pay back shareholders. But typically what happens in the case of these types of businesses, Kate, is for every dollar that shareholders have invested, they would be lucky to get a cent back on the dollar, if anything at all. Normally, there's only enough to cover the loans. And even then, maybe not that much. And then even the banks that finance them have to incur a loss as well. So in the case of Booktopia, obviously there's maybe something else that can be done. But yeah, great case study for the future.
Wonderful. The next question is from Long-Legged Lizard. Hi, Owen, Kate, and the Rask team. I wanted to know if you had any tips and tricks about keeping up the habit of investing when you're planning on spending an extended period of time overseas, maybe 3 to 5 years. Before quitting my stable 9-to-5 job to pursue working holiday visas overseas, I used to make regular contributions to my ETF portfolio. However, with the inconsistent nature of seasonal work, backpacker-style jobs, and dealing with foreign currency, making the minimum $500 purchase that might be required by brokerage platforms has been challenging. I understand I'm choosing to prioritize experiences over growing wealth, but I'm still wanting to maintain the habit. Would you think investing spare change in a micro-investing account would be the way to go, or scale back and make less frequent contributions to my existing brokerage account? Any thoughts appreciated?
What do you think?
I think it's great if you can keep the habit up, whether it's $5 or $500, where you can. Like prioritizing the experience is fantastic, but if you've built all these great habits, is there a way you can still put a small amount? So when I went overseas, well, I was planning to go for longer. I did intend to keep making small contributions, but a lot less than I would have done when I had a stable income coming in. So for some bits of my investing, I might have paused what I was doing because I had a regular contribution plan. In some cases, I reduced it. So instead of doing a larger amount, I set up so it was a regular contribution of a much smaller amount, and maybe I put the money aside for that. Maybe if it's a mortgage, you can pre-put the money aside for those repayments. But I can appreciate it. It's a bit complex if you're earning money in different currencies and paying for living costs. It can be a little tricky to send money back to Australia.
Yeah, it is. It is tricky. Having some friends that have moved to LA or like London or just different parts of the world, it all depends on kind of your goals as well. But I would just encourage this person and anyone that's considering going overseas to speak to their accountant first and foremost, because there are a number of different rules that apply to your tax position, and it can actually vary depending on where you go
and how long you go.
How long are you planning on earning over there? Are you a citizen of the country that you're planning to go to, or are you not? So there's so many different things to consider in that regard, and one of them is basically this very simple test. There's a few of them, but one of them you can Google on the ATO website is the 183-day test, which is basically testing will you be in Australia for more than half the year? And like, will you be earning money and be a tax resident here? And the thing that's important to understand here is that the ATO is trying to figure out, are you going to be taxed by Australian rules, or are you going to be taxed as if you're not Australian and you're a foreigner kind of taxable income? So they're trying to figure that out. And then whatever country that you're going to, and if you're going for 3 to 5 years, you're going to probably be working over there. They're probably going to ask the same question. And then they'll also, both of those tax jurisdictions would ask the question, is there a treaty between these countries for tax already paid and these types of things? And I know this is a really, really big problem for Americans that come to live in Australia, because the American system is much more strict on this. You still have to do tax returns. You still have to do all that sort of stuff. So that's the first thing that I would consider. You may get to the bottom of that and be like, it's actually not worth me putting money back in Australia and doing all of that right now. In which case, maybe you just have it in a savings account and you keep your life a bit simpler and less headaches. But in terms of the savings habit, I mean, and the investing habit, you might just say, you know what, I'm prioritizing, as you said, Kate, this part of my life, which is travel, experiences, this type of thing. Maybe instead of, the habit of dollar cost averaging, maybe you have the habit of just listening to finance podcasts or reading finance and investing books or investing in your education. So when you do come back, that doesn't have the tax consequence, but it has the consequence of you earning more and you being a better investor, or you being smarter with your money. And that itself can pay dividends, literal dividends, for the rest of your life. So there are other ways to compound, other ways to keep a really healthy habit with money beyond just putting money into some account that maybe grows over time. Now, personally, if it was me, I would probably still use a micro investing account. And I think that would be okay. I would use something like Raise or Pearl Micro, which I mentioned, or Sharesies. Obviously, for folks that aren't aware, when we say micro investing, it's still investing. It's still investing. You're still investing in the share market or ETFs or whatever the case may be. You're just investing smaller amounts in a different way. So instead of having like $500 to invest in one go, maybe you invest $5. Fees are a little bit different in terms of how they're calculated, as is the legal ownership structure. But at the end of the day, that they exist because they know some people, or a lot of us, to be honest, can't always invest $500 whenever we want to. So the reality is, like, they're still investing. And then when you build that up, you can always then cash it in and invest in an ETF yourself.
Yeah. And maybe you just put some money aside until you hit $1,000 and you invest $1,000 every 6 months. That doesn't mean you're not an investor. You're changing the frequency, you're changing the amounts to suit the life stage you're in at the moment.
Yeah. And of course, like, I think, one of the things that we ask on our Australian Investors podcast when we do our interviews, the question we ask every new guest is, if you could go back in time and tell yourself one thing about investing, finance, money, life, what would it be? And I would say 8 out of 10 people that come on the show say, just get started, start sooner, or to an extent, keep it simple. It's like one kind of those 3 responses are the most common by far. And the idea is that probably their biggest financial regret is not getting started earlier, whether they held off because they were over-saving, as in the case maybe with our first questioner, or something like that. They just wish they just got started. Now, I have similar types of feelings because I think anyone who understands investing know that the one superpower you have in life when it comes to investing is time. You don't have to do anything special except just invest, and time will do the rest. But the reality is we can't get time back. So a lot of people have that similar regret, or, would give them their younger selves that kind of advice. But the reality is, we also have lives to live. We also, if you speak to some people who were those over-savers, those over-investors, if you will, their biggest regrets in life are not going on the AAA, are not taking that career change that they always wanted to swap into, are not, pursuing that relationship because it fell apart because of money reasons or whatever. Those are the people that have the really visceral regrets in my life, in my experience, not the people who are like, oh yeah, I know, I wish I could have just saved, an extra $50 a week or something. Like, that's a regret, but in the scheme of things, it's probably the lesser of two evils, in my opinion.
Yeah. And if you've already started investing in ETFs and you've got superannuation in Australia, that's going to still be invested while you're traveling and experiencing the world and working overseas. That's still invested. So you're still getting to benefit from the long-term growth of your portfolio.
Absolutely. Absolutely. And it's a good position to be in. Have fun, enjoy your life. That's what money is, the tool for that. It's not like money in itself shouldn't, in my opinion, be the that shouldn't be the end goal, but what it allows you to do. And so
It's an enabler.
Exactly. Well said.
All right. Now, changing tack completely. We're going to talk about something a little bit more technical.
Yeah, sure.
Exciting. I don't know. Bonds.
Less
Depends how you feel about bonds. But this question is from Curious Cucumber. I'm 25 and have started investing early this year after finding the Rask resources.
Mm-hmm.
So far, I've only been buying index ETFs, e.g. S&P and ASX. At what point in my investing journey do I need to worry about investing in bonds or cash ETFs?
It's a good question. And Curious Cucumber, obviously we do not know your situation, and hence you've given us an anonymous name. So there's absolutely no way that we could know anything and we could identify you. So I just want to make that clear. There used to be this old rule, Kate, about bonds. Actually, maybe I'll start with what bonds are. So most people, the longer you go in finance, most people realize that there's other things that you can invest in beyond just shares. So we know that there's shares, there's property, there's like savings accounts and cash accounts. Those are kind of like the three staples of the Australian investment diet. But if you go overseas, you will discover that there's this extra one, which is, it's not, I don't think it's as big as property, but it's bigger than all of them. It's called bonds. And bonds are a slightly different type of thing. And it's actually interesting if you think about how most Western societies are constructed, is that most of Western society uses debt in some way. And so we use like a mortgage on our house, you get a car loan, you go to the bank and get a credit card.
If you're starting a small business, kitting out a cafe, you're getting a business loan.
Exactly right. So that's all a form of debt. And most of us are familiar with this idea that when you have debt, what you do is you pay back the original amount, the principal, but you also pay interest along the way. Now, that is exactly what a bond is. A bond is, my word is my bond. I promise that I will repay money to you that you loan me, and I'll give you some interest along the way. Now, there's a lot of fancy words and jargon that come along over time, but basically that is it. And governments issue these things. They're called, government bonds. Governments use these too, and pension funds buy them. So the government says, I promise that I will repay you, Australian Super, if you buy $1 billion of these bonds. And then the Victorian government takes that and goes and tries to build a freeway, gets botched, doesn't happen. Government's on the hook to pay a super fund back. But these things happen, right? And that every layer of society basically uses this type of financing in some way. And you as an individual investor, you can also buy these bonds. So if the government comes out and says, we're going to issue, some bonds, we're going to pay you 4% every year for 10 years. You can go and buy them in an ETF. And the ETFs wrap them up, and there's a whole, there might be hundreds of these bonds inside this one ETF, and you can just buy the ETF now. And that's wonderful because retirees can get a good amount of interest. Even people like us, can get a good amount of interest. Whereas in the past, typically bonds were only for really big investors, because typically one load of bonds was $1 million worth at a time. Mm. They didn't do $100 worth, right? So basically what the idea is that bonds are lower risk and shares are higher risk. And if you mix them together, you can get consistent income from your bonds as well as some dividends. And then you get the growth from your shares. That's basically the way financial markets have operated and investors have operated. Now, this is a long-winded way to explain what they are. But then a lot of people are now asking, hey, with interest rates a bit higher, I see that bonds are all of a sudden paying 4 or 5% in quote unquote interest every year. Could I start using some of them in my portfolio? And the answer is yes, because when interest rates are low, you're not going to get much interest. But when interest rates are high, you're going to get a good amount of interest. And so investors now are using them, and we use them at Rask Invest. We've had them in the portfolios for the last couple of years. And they're really, really good. The older you get, the more important they become, basically. And there used to be this old rule, I don't even know what it's called really, but basically you'd get 100 minus your age, and that's what you should have in shares. So if you're 20, 100 minus 20 equals 80% in shares. And that means 20% in bonds. And so that's how you would build a portfolio over time. And you would effectively create this diversification. Now, over time, what's happened is that rule's kind of gone away and people have started using more than just cash and bonds, like these two different things. But I would think that as you say hit 35 or 40, you're starting to add bonds into your portfolio, or at least considering them. So you might only have 5%, 10%, whatever. We've spoken to some actuaries over the years, okay? And it's interesting because the actuaries come out with a scientific formula and say, this is how much you should have in bonds, this is how much you should have in stocks. And then I ask them, well, what do you do? And they're like, I'm just 100% in shares. And so even though these rules exist and the formulas for how people, build portfolios have existed for a long time, I think there's also a behavioral element that comes in, and that the longer you've been investing, the more comfortable you feel taking risk, i.e. buying more and more shares and less bonds. At my age and the way I invest, we have the Jupiter strategy at Rask, which is 90% in growth and 10% in defensive, and that's the formula that I follow. It's just, for me, it's not necessarily saying it's right for everyone, but that is by far the most popular option we have at Rask, even for older people.
Now, Owen, you mentioned sort of bonds might be paying 4 to 5%, but on our savings account episode we did the other week, we talked about savings accounts, term deposits. They're paying 4%, 5% at the moment on your savings. So what would be the advantage to using bond ETFs and cash ETFs over a term deposit or a high interest savings account?
So if you remember, that's a good question, Kate. If you remember this one rule, it's just that the price of a bond ETF moves in the opposite direction of whatever the interest rate changes to. So for example, if interest rates fall 1%, some bond ETFs, like the price of the bond ETF, can go up 6%. I don't want to bore you with what the technical term is, but that's basically how they move. They're not like one for one. It's oftentimes that bond in an ETF form, they will go up when interest rates go down. And so you might be thinking, well, that means there's some risk. And yes, there is. But if you think about the way our economy is at the moment, where the government and the central bank has come out and said, interest rates are pretty high, people are starting to feel the pinch. Like you and me, Kate, we've got mortgages. It's starting to feel the pinch. So what do? They consider maybe in the future we drop interest rates, which pushes up bond prices. So not only do you get that interest rate that I mentioned earlier on, kind of similar in a way to the interest you might get on a term deposit, but you also get the opportunity that the value of your investment goes up as well. The key thing to keep in mind is that it's not like a share ETF, which can go up 4% one day, down 4% the next day kind of thing. It's not that kind of a roller coaster. Mm-hmm. It's more just kind of like a steady, like it goes up 0.5%, goes down 0.25%. It's like more incremental. And so that's why a lot of people have them in their portfolios, but it's also why some people switch out of them if they think the opposite is going to happen. Interest rates might go up and therefore bonds go down. Just one final example. I don't want to bore people too much with bonds, but one final thing on this is that people have come to us and said, like, we've got a lot of bonds in our portfolios. People have come to us and said, why would you buy that? Look how bad the chart is on Google Finance. The bond ETF has gone down. Like we own the IAF ETF, which is one of the ETFs that we own in our portfolios. And people look at the 5-year share price chart and they're like, why would anyone buy this thing? And that's because in the last 5 years, interest rates have gone up, right? So that's why the bond has gone down. It's done exactly what you would expect it to do. And so if interest rates go the other way, maybe in 5 years we say, oh, it actually went up. That was a pretty good time to buy. And so that's how you think about using bonds in a portfolio.
Wonderful. All right. The final question was from Brucey Boy. New listener, but would like a playlist to easily go to, use and share with family and new investors of our key Spotify episodes. For example, the 101 series on cash, shares, managed funds, etc., or the ETF series. It's a little tricky to find things, which given we've been going for so many years, we have episodes on every topic under the sun. We've got so many great guest episodes. So I've made a few Spotify playlists. So, for example, our ETF mini series we did the other year, which sort of goes through the 101 on what ETFs are, how to invest in them, how to choose a broker, all of that kind of stuff. I've packaged up in a Spotify playlist so you can just press play and listen to them all in one spot. I've also created some more. So I'll put links to each of these Spotify playlists in the show notes so you can listen to them, share them with friends and family, and spread that finance knowledge.
Yes, that's great. And you do a really good job of that, Kate. Our most popular playlist on YouTube, which is where we have a bit more control, like in podcast player land, just so everyone's aware. If you don't create your own podcast, you probably don't know this, but when you go into your Spotify app or you go into Apple Podcasts, we don't actually have control. We can't necessarily go in there and just make playlists for you. If we could, we would definitely do that. Like we can now with Spotify, thanks to them. But with Apple, there's like no hope. So what we try and do is on our YouTube channel, we try and put things together. And we even go one better in our courses. So our courses are probably the best thing to share, because even if people aren't really course type people, what you can do is you can go into the course, just enroll in the free course, and you can see which episodes apply for the topics. So if you want to learn about ETFs, or you want to learn about property, or you want to learn about the beginning of share investing, like we have courses on all those things, or like debt. You did some fantastic courses with Tash Invest, Natasha Eisman. So like there's so many great podcasts and videos all collected in one area for you. So we'll continue to keep doing better, and we're currently doing a bit of a brand redesign, which watch this space. We'll make an announcement about that shortly. But in the meantime, Kate's got some great resources. And just as you were saying that about episodes, Kate, I just had a quick glance. I think we're coming up on 1,500 episodes across the four main podcast channels.
Surely that's enough.
We've got a long way to go, okay? We've got many years to go. But seriously, there's some absolute gold in that vault of podcasts. But we'll do better at surfacing that for you. And if in doubt, just jump into the community and say, hey, I've got a friend that wants to learn about X, Y, and Z. What would you guys tell me to share with them? And we'll tell you. And the other community members will say exactly the same thing.
Yeah.
And they might not even be our podcast. They might be someone else's that we think, hey, check this out. Like we did that yesterday for some investors who wanted to learn about US stocks. I'm
fairly agnostic. If it's a great resource, I'll share them all with you.
Oh yeah, absolutely. It doesn't matter. Like we're going to share with you whatever may come. And if that's not one of our podcasts, sure, like it's whatever's best for you. So just write into us if you do have friends or family. And we're also happy to create like little investor packs. We've done a few of these over the years. We've got PDFs or like I've got a Google Doc. It used to be on my Twitter account. It lists out all of the podcasts that I would listen to in order, even non-Rask related ones, like all of them that I would list in order to become like a share investor or an ETF investor and so on.
Oh, maybe you can share that with me and I'll put it in the show notes.
Sure. Sounds good.
All right. Well, wonderful. We covered plenty of questions today. So if you have your own finance question, send it to us via the Ask a Question link in your podcast player or via the show notes. And we look forward to answering them on the next Q&A.
Yes. And if I could leave everyone that listens to this with one thing, and this would be for people that are the savers in the room, just remember what we said at the very top of the show. Saving alone probably won't get you to your goal. Unless you're like earning the big bucks, it probably won't get you to where you want to go. If you, for example, want to retire early or you want to build wealth and passive income, it won't, because at the moment, interest rates are pretty good on term deposits. But you need to go back a couple of years to know that wasn't an option. And so the best bet you have, no matter what stage of life you're in, is to invest. If it's $5, if it's $5,000, it doesn't really matter. Just get on that journey, start that journey today, see what you have available, and get yourself into a position where your financial house is rock solid, and then think about the long-term you. That would be my kind of key takeaway from today's episode, Kate.
Amazing. Well,
cool.
Owen, thanks for joining me.
As always, Kate, it's a pleasure. Thanks for joining me. Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.